Hi there. Today we're going to talk about one of the most misunderstood and controversial financial instruments in the world of bonds, subordinated bonds. What's really behind this complicated term, and why do even seasoned investors approach these with a lot of caution? Why do banks issue them, and how can you actually make money from them, or lose every last dollar? Stick around until the very end to find out how not to fall into the trap of high yields and how to protect your capital when dealing with subordinated bonds. If you find this video helpful, don't forget to give it a thumbs up and subscribe to the channel. That really helps support the project. Subordinated bonds are basically the roulette wheel of the bond casino. The potential returns are high, and the payout looks great on paper, but the risk of losing it all is just as real. In financial terms, the word subordinated literally means lower in priority. And that's not just some abstract label. We're talking about actual payment priority here. If the issuing company goes under, the people holding subordinated bonds are going to be at the very end of the line for any payouts. Only shareholders get paid after them. Everyone else, holders of regular bonds, the tax authorities, even the company's employees, all come first. From a legal standpoint, subordinated bonds are considered debt instruments, but they sit lower in the company's obligation hierarchy. If a bankruptcy occurs, the order of payment starts with secured debt, followed by unsecured debt, then senior bonds, and only after all of that, subordinated bonds. And if there's anything left after those payouts, only then do subordinated bondholders get anything. If there's nothing left, well, those were the risks you took from the beginning, and they were never hidden. Don't forget to join our Telegram channel. We post updates on upcoming videos, fresh content, and detailed breakdowns of investing topics. You'll find the link in the description or in the first pinned comment. But wait, if subordinated bonds are so dangerous, why would anyone in their right mind buy them? It all comes down to one thing: the yield. These bonds often offer significantly higher interest, sometimes several percentage points more than senior bonds issued by the same organization. In certain cases, this yield gap can be 3% or more. And if we're talking about euro bonds, the difference can be even more dramatic, especially when compared to traditional instruments in dollars or euros. It's as if the investor gets a little extra bonus, but that bonus is the price of taking on greater risk. Sometimes the numbers can seem almost unbelievable: 10, 12, even 15% annual returns, while regular bonds from the same issuer might only offer 5. If you're new to this world, you might think you've stumbled across a hidden gem or an overlooked treasure, like the market has mispriced this bond. But the truth is, the market knows exactly what it's doing. It's not mispricing, it's risk pricing. In investing, high returns almost always come with high risk. It's not a gift from a generous issuer, it's compensation for the possibility of loss. But there's more. Another key feature of subordinated bonds is that they often cannot be redeemed early by the investor. That's right, you can't just pull out your money when you want to. But the issuer? Oh, they can. And sometimes they'll even buy the bond back early at a price lower than the market value. Worse yet, in some cases, the issuer can just stop paying the coupon. And believe it or not, that's totally legal. It's not considered a default. It's all spelled out in the contract from day one. This setup gives the issuer more flexibility, but it leaves the investor in a vulnerable position with little control and no guarantees. And in global finance, things can get even harsher. Under Basel III rules, for instance, a bank has the right to write down subordinated debt to zero if its capital ratio falls below critical thresholds. And here's the kicker. This can happen even without a formal bankruptcy. The bank keeps running, but your bond, gone, completely wiped out. And yes, this isn't just theoretical. These cases have already happened in real life. Now let's talk about why these instruments even exist on the market in the first place. And this part is genuinely interesting. Banks are by far the biggest issuers of subordinated bonds. When they need to quickly boost their capital, especially their Tier 2 capital, they turn to these instruments. Under international standards like Basel III, subordinated bonds can be counted as part of a bank's capital buffer. That's a huge deal, especially for banks that can't issue regular stock anymore or are already swimming in debt and can't afford to release traditional bonds. Instead of diluting ownership by issuing more shares, which would upset existing shareholders, the bank simply issues subordinated bonds. It's faster, easier, less regulated, and more appealing in many ways. If things go smoothly, the bank doesn't have to share any of its future profits with new stakeholders. To regulators, these bonds make the bank look more stable. To investors, they represent a high yield and high risk on opportunity. By the way, we've just published a new article on our website. It's packed with free educational content on stocks, bonds, and ETFs, whether you're a complete beginner or looking to deepen your knowledge. Go check it out and be sure to bookmark the page. Subordinated bonds are also known for having very long maturities, and that's no accident. In fact, 5 years is usually the minimum term, but most of them last 10, 20 years, or even have no maturity date at all. That means the principal might never be paid back. Sure, you'll receive coupon payments, but the actual bond amount? That's entirely up to the issuer. Some people even compare these instruments to preferred shares with a fixed income. You don't get any voting rights, but as long as the issuer can keep paying, you'll receive something back. For the issuer, this setup is a goldmine: long-term or perpetual money, minimal obligations, and the legal right to cancel the debt in a downturn. For the investor, though, it's an ongoing source of anxiety. You have to keep track of not just credit ratings, but capital adequacy ratios, what the regulators are thinking, and the company's internal situation, and all of that just to get a few extra percentage points of yield. Now you might be thinking, with this level of risk, only desperate gamblers would touch these things. But that's not true. Some of the biggest investment funds in the world are actually happy to buy subordinated issues from top-tier banks. Why? Because the yields are attractive and the issuers seem trustworthy. If we're talking about systemically important banks, the chance of collapse seems almost impossible. Meanwhile, the yield difference, maybe just 1 or 2%, translates into millions of dollars in extra profits when you're managing $1 billion portfolio. So don't forget to smash that like button and subscribe to the channel if you haven't already. Your support really makes a difference. And if you'd like to help keep this content coming, check out the membership platform. The link is in the description or pinned comment. More deep dives, analysis, and practical guides are coming soon.